Most people think lenders evaluate how much credit card debt you have. That is only part of the picture. Lenders evaluate patterns. Credit card balance behavior, what we call revolving stability, plays a direct role in how your credit profile is interpreted. It is not just about whether you carry a balance. It is about how consistently your balances move over time. This is part of Layer 1 of the Financial Identity Framework, behavioral signals. Behavior is the foundation. When lenders review a credit profile, they are looking for predictability. Predictability lowers perceived risk. Volatility increases it. Two people can owe the same amount on their credit cards. One profile shows steady balances, small fluctuations, consistent payments, gradual movement. The other profile shows sharp spikes, rapid paydowns, sudden increases, then drops again. To a lending model, those two profiles do not communicate the same thing. Revolving stability refers to how consistently you manage your credit card balances over time. It answers questions like, are balances steadily controlled? Do they rise and fall dramatically? Do they remain near limits? Do they cycle unpredictably? This matters because lending decisions are probability decisions. Lenders are not predicting perfection. They are predicting future behavior. If your past behavior shows stable balance management, models interpret that as a higher likelihood of future stability. If your balances fluctuate dramatically, that can introduce uncertainty, even if you never miss a payment. This is where many people misunderstand credit behavior. They focus on utilization percentage at a single moment. But lenders evaluate movement. Movement over time reveals habits. For example, if someone repeatedly maxes out a card, then pays it down aggressively, then maxes it out again, that pattern suggests dependency on revolving credit. If someone maintains moderate balances and gradually reduces them over time, that suggests controlled use. The dollar amount may look similar at different snapshots, but the pattern tells a different story. Revolving stability is about consistency, not perfection. You do not need to carry a balance to show stability, and you do not need zero balances to appear responsible. What matters is that your balance behavior does not communicate volatility. Volatility increases perceived exposure. Exposure increases risk interpretation. This connects directly to lending decisions. When underwriting models assess a credit profile, they analyze historical balance patterns to estimate future borrowing behavior. Stable revolving behavior reduces uncertainty. Reduced uncertainty lowers risk classification. Lower risk classification increases approval probability. This does not guarantee approval, but it strengthens interpretation. Think of it this way. Behavior is the signal. Structure provides context. Timing shapes interpretation. Risk interpretation combines them. Revolving stability lives inside behavioral signals. It is one of the ways lenders assess whether someone manages available credit in a controlled way or reacts to financial pressure through sharp swings. Even if your utilization percentage is currently low, unstable historical behavior can affect how your profile is evaluated. Consistency communicates control. Sharp fluctuations can communicate stress. Again, not because the model is emotional, because the model is statistical. Statistical systems prefer predictable inputs. Predictable inputs produce predictable outcomes. That is what lenders are looking for. not perfection. Predictability. When credit card balances show steady management over time, lending systems interpret lower future default probability. When balance behavior appears erratic, models may classify the profile as higher risk, even if no late payments exist. This is why revolving stability matters. It is not about avoiding credit cards. It is not about eliminating all balances. It is about communicating controlled use. Layer 1 focuses on behavior. Payment cadence showed how timing matters. Revolving stability shows how balance management patterns matter. Both contribute to behavioral interpretation, and behavioral interpretation feeds into risk classification. If you understand how balance patterns are evaluated, you begin to see why approval outcomes do not always match expectations, because lenders are not just evaluating numbers, they are evaluating patterns behind those numbers. In the next episode, we will continue expanding Layer 1 and examine how behavioral consistency interacts with structural positioning and why the same behavior can be interpreted differently depending on account arrangement. Behavior is the foundation, and stable behavior communicates strength.